Hey.
Hey.
Hey. Right. Good. How's it going? Good.
Normal crazy running like a chicken with my head cut off, feeling like I'm behind in everything and I'm not really excelling.
Well, you feel like you're behind. That's better than actually being behind like I am. So.
I don't know.
Little bit better, not handle it good. Yeah.
How the testing go for you? Yeah.
This.
I did. I feel like I did not. I went on part one where that's the one I should have really felt that. But I got. Yeah, but I got a 75 plus 1 and then I got a 75 2. But I was really proud of myself because I was like, oh yeah, like I got the same score from the first test. So
Well, that's true.
even though it's still not a great score, I feel confident in myself where I was like, all right, you got it. Like you're gonna survive. So.
Yeah.
Trying to set up.
Yeah.
Priest.
Yeah. I'll be got a pretty good average. The goal is to not get below 75. So. Like,
Right on.
but yeah, let's see. Yeah, well, it's not. What about yours?
Same.
Mm. So that's actually on my to-do list for spring break next week.
Yeah, same.
I'm gonna utilize my driving time. To actually get some stuff done, or when I would be driving, like.
Yeah.
On a normal week.
I've got flight time. I have a 17-hour flight
Go to Europe.
to go to Asia or Southeast Asia.
Spring break?
Yeah.
Nice.
Have you been to Asia before? Or is it just? Europe?
Yeah, I've been to Asia a number of times, actually, quite a few times. I've only been to Southeast Asia twice.
Oh,
That's
that's so
incredible.
fun.
So this is my second time in Thailand. It's
And you're going just for
Awesome.
like vacation?
Yeah,
Yeah.
it's super far away.
I heard that Thailand is great.
Like imagine flying to Europe and then turning around and flying back, but it's all like nonstop one flight. That's how long the flight is.
You went to Europe last year too, didn't you? Or was it 2 years ago?
Went in December and I went in May last year.
I'm gonna live through YouTube because you're gonna be at the
Yeah.
beach, you're gonna be in Thailand. Are you gonna be in one?
I don't know.
Me either. I'm gonna be sitting in
Party.
southern Missouri. Probably drinking Tito's and.
Dude, there's nothing about that.
So the entire class yesterday is going down for cheating, I'm pretty sure. In my dad's class.
Again?
Oh yeah, he had people literally get up in the middle of a test and go ask people sitting like 2 rows over answers to questions. Cause he was helping people with Excel because it was like getting jammed. And like he was like helping me a couple times, but
Yeah,
he like would walk or be helping someone with Excel and they'd walk across the room and ask their friend a question. And I'd be like, how are you even supposed to grade that?
I almost sent him an email today because I was thinking about him because I think that he was super.
Yeah, he was,
Frustrating.
and he had 9 people cheat on quiz 1 that he graded yesterday before that class. He like yelled at us about cheating before. He had a girl like take her phone out, walk to the bathroom, text a couple friends some answers or for some answers on the test, then come back 25 minutes later to finish her test. I'm like, man, yeah. Yeah.
He's like getting
Yeah.
out of control,
Like,
man.
what do you do?
They're taking advantage of your father's lackadaisical nice ways.
Yep.
Which are very not like
Well,
good as a
so-
professor.
like. I did not partake in the quiz 1 shenanigans, so,
yeah.
but like, would. For one, if I were to engage in that behavior, like, don't just copy and paste,
So-
like.
Oh,
like,
someone
at
pulled an
least-
answer off the CFA website verbatim. It was my dad's key. He used a CFA exam question.
Yeah.
And they copy and pasted it. They didn't reword anything. My dad's like, I'm calling BS on this one. There's no way you rolled out the exact same answer to the key. And it was like the top student in the program. He was like, I don't even know what to do about this one. We can't kick out our top student.
There's some ingenuity there. There's the point or two.
Yeah.
When you get out into the real world, you know.
What's
Well,
crazy is it was an in-person test. It was the in-person test. It wasn't like you had Google on you.
So,
They just whipped out their phone and under the table and they're just Googling stuff. I'm just like, what?
At least.
Come on, man.
Like,
Yeah.
Is he gonna even grade it, or is he gonna make
Uh,
us redo it?
He talked about making us redo it, but we don't have time to redo it because we're already behind.
what class is it?
Portfolio management. Oh, he gave all 9 people zeros, and then one of the guy that didn't come to class that had to present, who cheated online. My dad emailed him yesterday to drop the class because he cheated online again when he wanted everyone to take it in person.
I don't feel like we had that issue.
We did
No.
not have that issue. I
No,
don't-
you
Well,
guys-
there were a couple, I think, that were.
My dad liked your class better than ours, even though you guys lost like 500 grand or
Well,
something.
that was, yeah, not really our fault.
Like, what happens when they do, like, those 9 people, like, like? do
Oh, they just get zeros and they get to try to complete the class, but when it's a 4 quiz class and you get a 0 on one, you're already down to a 75.
I'm just surprised that they don't get, like, terminated from the program.
Yeah,
I guess.
Kind of like Matt, like, gotta do the stupid CFA ethics thing, got to be plus in the class, is what I heard.
Me?
Yep,
I didn't do what?
the CFA ethics thing, that's what my dad was saying. He's like, someone like Matt or something, you could do the CFA ethics thing, and that's why they get an A.
Really? I didn't, maybe I didn't even know I was supposed to do that. I thought I did. No, I did.
Maybe.
You missed a
I'm
lot.
gonna look into this.
You just missed a lot of boring videos.
Sorry.
I guess it's do it. I was on spring break last week.
Same,
and
kinda.
I gather everybody's off to early spring break this week. And to be honest, I don't blame them because this is the most technically complex lecture of the entire semester. And this is the 6th edition of the book. In the 5th edition of the book, leases, pensions, and taxes were 3 modules. Now they're 1, which I guess maybe in one way is better news because there's less of that to cover, less testable material. But in order to get the answers right, we have to go in depth and we have to do it all inside of an hour and 15 minutes. So we're gonna talk about leases, pensions, and taxes. I'm gonna try to point out some of the aspects that typically trip students up. And I'm gonna jump right into it, unless there's something else that we need to be covering right off the bat. Okay, and I'll apologize in advance for this lecture too. You know, sometimes walking out of class thinking, okay, that sounded pretty good. Other times I'm walking out of class thinking, man, I wouldn't have wanted to have to sit through that lecture. I woke up at 2:30 last night because my wife and my dog were having a snore off. There was who could outdo one another. So I got up and went down to the couch in the living room and that was pretty much it. So anyway, I'm dragging a little bit. Let's see if we can make this even halfway interesting, right? And it's timely. I expect most of you have been watching some of the news this week. Last time we got together, we were talking about accumulated other comprehensive income. And we were talking about some of the accounting that ends up with companies reporting this thing called other income, other comprehensive income. It's not net income, it's other income. Well, Silicon Valley Bank had a bunch of other income, which was actually an other net loss. It's investments in their held to maturity portfolio, which as you'll recall, don't flow through the net income statement. All of those gains or losses flow through other income. So they were hidden a little bit. You had to know where to go looking for those to recognize the solvency or insolvency, in this case of Silicon Valley Bank. That was a big part of, their liquidity crisis. All of the investments that they had made, held to maturity investments that they had made were in, not necessarily unsafe investments, long-term treasuries, but they had taken significant losses with this rate rising cycle. And when we had just a little bit of a run on the bank, they had to go to their held to maturity portfolio and free up some cash. To do that, they had to sell those held to maturity securities at significant losses. Those losses had been booked in other income, but the transaction forced those losses from other income to net income, and the headline led to a run on the bank, and that bank went under. So very interesting week in Wall Street. Okay, gonna turn this in. Do it. Slideshow. Oh. Okay, let's talk leases first. Anybody in the room today have a car lease? Nobody, okay, you probably know somebody.
I do.
Oh, awesome, we got somebody on Zoom, okay, terrific. So you have a car lease, that makes you the lessee. So you rented that car from the lessor, and in that leasing transaction, you take possession of that car, and the lessor, the institution who rented you that, or leased you that auto, is the lessee, and that is a contractual contract that you entered into. And the terms of that give you right to that auto for usually 60 months, 72 months, something like that. There's going to be an interest rate associated with that. Okay, I don't expect that anybody in this class is unfamiliar with the way that typical leases work. We want to go through the accounting for leases, which can be a little bit more complex, especially when we get into looking at companies like Southwest Airlines. Delta Airlines is the example that our authors use in the book for module 10. Well, they're just huge. The numbers that you get when you're leasing an airline fleet are in the billions. So the accounting, even though it can be subtle and nuanced, can have outsized effects on your earnings. And when you're playing the little game of find the penny, you need to understand how the differences in the two major types of lease treatment can impact your financials. And there's two different types of leases, a finance lease and an operating lease. The primary difference is what happens at the end of the term. Finance lease says that a particular lease is substantial in form to a purchase. So maybe you're going to take maybe you're gonna take your Toyota 4Runner and you're gonna rent it or lease it for the next 20 years. Well, what's that car worth at the end of 20 years? Almost nothing. You've de facto bought that vehicle. Maybe that lease and the terms associated with that contract give you what is called a bargain purchase option at the end of the lease. So at the end of the lease, you can buy it for $1. Everybody's gonna take advantage of that. Obviously, that's a de facto purchase. So there's 6 or 7 different criteria that the accounting regulators give us to identify a finance lease. And when we identify a finance lease, we're basically going to account for that as if it were a purchase. An operating lease is a little bit different. We're going to similarly account for that as if it were a purchase by putting the asset on our balance sheet and the present value of all the lease payments on the liability side of our balance sheet. But we're going to book lease expense for the full value of the payments that we make throughout that lease. Whereas in the case of a finance lease, we're actually going to book interest expense and amortize the property over the lease term. So this is complicated, but getting less complicated because FASB changed the rules on us in 2019. So here we are, 20, 21, 22. Most of you will be looking at 2022 financials. So you should have a 3-year period of time where they're similar in form. In 2020, this was a huge pain because we had to go back and restate all of the financials so that we knew we were looking at apples to apples across years. And then there were two different ways to do it. You could have a retroactive adoption where you restated all of the financial statements, or you could have a prospective adoption where you just draw a line in the sand and begin accounting for leases according to the new accounting treatment. Before this new standard went into place, operating leases didn't even have to go on the balance sheet, which was the reason why we adopted new accounting rules, because it was a way for companies to sidestep the number of liabilities that they really had on their balance sheet. Now you can go get the 10K printed out, look in the fine print, and you could see the obligations that they were on the hook for over the subsequent 5 or 10 years. You could do that, you could adjust for it, but in practice, analysts don't do that. And I think that's the real value in this course, because if you know where to look, you can always get an accurate read on the financial statements. But it takes some real talent to be able to do that, because companies hide it in this type of language. So you gotta get out the 10K and go find exactly what it is that the company's doing, which is hopefully one of the real pieces of value in taking this course, is that you get to dig through a 10K. For many of you, this will be the first time you get to dig through the 10K. And I think if you go into financial analysis as a career, by the time you've done it a dozen times, you pick up the tricks of the trade and you can quickly zero in on the accounting treatment, how it may or may not be material to the case that you're trying to make. So our authors give us here Home Depot, Microsoft. They give us Microsoft's books. You can see that their finance leases show up on their balance sheet as property, plant, and equipment. That's exactly how you would expect to see it if you bought the asset. Their operating leases show up in a separate line item, and they're labeled operating lease right of use assets. And I've touched on this before, but one of the more confusing aspects of accounting is that the nomenclature is not identical company to company to company. So I know the authors try to pick Microsoft because they have a fairly straightforward representation of the leases on their balance sheet. Great, let's use that. When you get into your own analysis, you might see something that's labeled a little bit different, and you're gonna have to do some digging. Go look at the notes, the footnotes to the financials to find out exactly what it is. At any rate, you see here that the operating lease is actually on the balance sheet, whereas formerly it was not. In the liability side of the balance sheet, you'll see that there's a current portion of long-term debt. Anything under 12 months is going to show up in that current portion segment for both operating and finance leases. And then in the 12-month plus section of the balance sheet, so anything over a year that's not a current liability, you're going to see long-term debt, which is the finance lease, i.e. purchase, and operating lease liabilities a little bit further down on the balance sheet. This will be, both of these will be accompanied by a table in the back of the 10K footnotes that shows the disclosures of which of those payments are coming due over the next 5 years. And that's going to be key to your liquidity analysis. So when you're looking at, does this company have the liquidity and solvency to pay those lease payments coming up? That table will be crucial. Here's the 1, 2, 3, 4, 5 terms that FASB lays out to assess whether or not a lease is operating or finance. So transfer of ownership at the end of the firm, whether there might be a purchase option. I mentioned bargain purchase option. The lease term, that was the 20-year example I gave on the Forerunner. If you're exhausting substantially all of the useful life of the asset, that's considered a finance lease. Present value, if the present value of the lease payments are substantially equal to the total value of whatever it is that you're leasing, well, that's a finance lease. And then lastly, if it's a specialized asset, there can be a cause for finance lease classification. Okay. Let me get my notes here, because I don't wanna. There's a lot to cover tonight, and I wanna make sure I get through it, so some of these slides I'm just gonna skip and leave you to. Kind of cover on your own, but hopefully those will be the more self-explanatory slides. At any rate. Okay, on slide 12, our author shows an example of the table that you'll find in the back of the 10K. And then. Skip over here to slide number 15. And we'll go through a little example. So in this example, we have total expense over the lifetime of the lease payments equal to $22,462. So we're executing a 5-year lease. And total lease payments are $22,462. Admit, welcome. Just in time for an example on lease payments. So we've executed a 5-year lease requiring annual payments of $22,463. There's an initial upfront payment of $5,000. That's pretty typical, especially when you're talking about an auto lease. The present value of the lease payments is 4%, or $100,000, and the company recognizes a lease liability for that amount. So the lease liability is booked at the present value of the total 5-year annuity, $22,463. Now the company is going to recognize a right of use asset at $105,000. So we have the present value of those cash payments plus the $5,000 upfront cost. And then the total lease cost under both operating and finance, regardless of the accounting, is the $117,315. So now on the income statement, on this is where the testable material comes in. This is where the financial analysis skill set comes in. We have to be able to differentiate between the operating lease and the finance lease. So when we go to play that little game of find the penny, we need to understand, okay, if there's any variability or opportunity to toggle a lease, toggle the accounting treatment from finance to operating, what exactly is that going to do to the income statement? Well, operating lease, pretty simple. We have $23,463 worth of rent expense or lease expense that hits the income statement every year. It's the finance lease that's a little bit more complicated because we have to compute the implicit interest, and then we have to book that as an expense. And that interest expense is going to be a non-operating expense. That's financing expense. And similarly, that may hit the statement of cash flows as a financing expense. So just be mindful of the amortization and the interest expense, which hit the income statement separately. That's how it's going to differ from an operating lease. Here's that example that I mentioned a moment ago about the Delta. So if you look at Delta Airlines, the lease section of their balance sheet, you can see operating lease right of use assets close to $6 billion in 2018. 2017, it was zero. That's that different accounting treatment that we were talking about. So when we changed the rules, all of a sudden, well, we went from zero assets to $6 billion in assets, but probably more importantly, we went from zero liabilities to close to $6 billion in liabilities. So that is it's a more accurate representation of the economics that drive Delta's business, but that's a huge difference. So all the ratios are gonna change, all of the, especially the debt ratios, that's gonna flow through, in big effects on the income statement, balance sheet level. Okay, so for releases, slide number 21 is your cheat sheet. So when you go into the exam, make sure you have this slide earmarked. Just put a star by this, have it printed out. You're likely to get most of your questions coming from this little, I'll just call it a cheat sheet right here, that shows you all of the balance sheet treatment for an operating lease as it is distinguished from a finance lease, and it's identical. The balance sheet is the same for both an operating and a finance lease, with the caveat that you just might have some different nomenclature and how it's described. The income statement. So for the operating lease, like we just looked at, the rent expense is recognized basically via straight line over the life of the lease. For a finance lease, we're actually going to book an amortization expense, and we're also going to book an interest expense. So that's the primary difference. And then the statement of cash flows, the lease payments are classified as an operating cash flow for an operating lease. That should be fairly straightforward to remember. And for a financing lease, the interest portion is classified as an operating cash flow. I misspoke a moment ago, I said financing. But the principal portion of the lease is classified as a financing cash flow. So star that page and come back to it. So as with everything, I don't expect for leases to be a big part of your semester research report, but it's up to you to determine the materiality. So you may not even have any leases. For a company like Microsoft, I didn't look at their how many assets they had on their balance sheet, but I don't suspect that leases were material to their balance sheet. If it's not material, then you can just move on. If it is material, you're going to have to jump through some of these hoops and make sure that you have a common presentation for the balance sheets, which might require some adjustments. Okay, so that's 20 minutes on leases. Now let's do pensions. Okay, analyze and interpret pension disclosures. We might have touched on this briefly several weeks ago. Much of the accounting for defined benefit pension plans will end up in other comprehensive income. And there's a good reason. If, I think if memory serves, Boeing still has the largest defined benefit pension plan in the country. And there's about $70 billion in that pension plan, a big pension. And they have reserved those assets to pay for liabilities that are long dated. They're going to be writing pension checks to employees that work for Boeing for the next 30 years. How do you account for that? I think I shared the example of my grandfather who retired from Phillips 66 in 1985. I think it was 1985. And he passed away in 2002. So for almost 20 years, he cashed a pension check that arrived every month from Phillips 66. And then when he passed away, my grandmother started cashing that pension check because it was a pension that delivered a benefit for not only his life, but the life of his spouse. And she's still alive. She'll turn 92 week from yesterday. So imagine the accounting that Phillips 66 has to go through when they're booking a liability. They know they're going to write that check for the next going on 40 years. So then that's probably, that check's probably $3,000 a month, so $3,000 a month for 40 years. You gotta get the actuaries involved, you have to figure the average age of your workforce. You have to come up with assumptions about how long they'll typically work, how many are gonna retire, what the payout of those retirees are, what portion of them are married. And you can make really good money as an actuary if this is your thing, working in this industry. So after you do all of the calculations, which we don't do in this class because they're given to us, well, we have to book that liability on our books. So now we have a $70 billion liability, let's say. And to fund that liability, we need to set money aside. And Boeing, Phillips 66 has been setting money aside for the last 50 years. So they actually have an investment account that is near $70 billion. What happened to that investment account in the last 6 months? Or the last 12 months?
Hasn't it decreased because of rising interest rates?
Yeah, it didn't matter where you were last year, you lost money. Equities were down 18%, fixed income securities on average were down about 14%. A balanced portfolio, which is where most retirees are, which is where most pension plans are invested in, was down 16% last year. What's 16% on $70 billion? Ouch, is what that is. So FASB says you don't have to take 16% of $70 billion, just call it $10 billion. You don't have to run a $10 billion loss through your income statement. So that's what happened. You just lost $10 billion. So the accounting for that is, well, we understand that the markets are volatile. And we understand that if we force that loss through the income statement, it would just make the whole thing gibberish. You couldn't make heads or tails out of any, because the $10 billion is going to dwarf the earnings that the company is able to generate during that accounting. So we're going to take that $10 billion loss and we're going to put it down into other income. Put it down there in the basement. And we're going to amortize that loss over a period of time. I'm going to show you how that works. Our authors do give us a little bit of information about a defined contribution business plan. Anybody do a 401k? Nobody in the one. Okay. So 401k. Every payroll period, your employer takes a little bit of your money. And if you're lucky, they match it and they throw it into an investment account for you. Well, that's just payroll expense. The account for that is super easy. Cash, we're gonna debit payroll expense, we're gonna credit cash, done. That's a defined contribution pension plan. Defined benefit pension plan is much more complicated, as I just described. Let's go through the terms and accounting treatment for defined contribution. So on slide 30 here, the bullet point that I highlighted for myself, which is a recurring theme throughout this class, I know, the footnote disclosures are going to be key here, and they are often very lengthy and difficult to decipher. And we are only just going to touch on the major terms and how they interface with one another. But when you start adding in other pension benefits, so let's all of a sudden get down into the murky world of healthcare, maybe life insurance. A lot of those benefits are afforded to retirees, so we'll have to account for those in a similar manner. Fortunately, in this class, we just have one slide that makes mention of, oh, hey, there's also a whole other genre of accounting called other pension benefits. And if you're interested in that, you can take an advanced accounting class that will take a much deeper dive into not only pension benefits, but that OPEB section of employee benefits. Okay, so let's start with terminology. The projected benefit obligation is how much we owe. That's based on actuarial numbers. How many employees do we have? How long are they going to work? What's their life expectancy? What are they going to be able to collect in retirement? So we need to know number of employees, salary levels, years of service at retirement, years over which those annual payments will be made. All of these are estimates. Ding, 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 ding. Your red flag goes up every time you hear that word estimate, because who makes the estimate? Management makes it. Okay, and management can change their estimates at any time.
I see that it estimates wage inflation. Does that just, is that considering raises or is that considering actual like financial inflation? Like actual like inflation in the market?
It's both. So financial inflation in the market will manifest in wage inflation, but that wage inflation is always, well, I'm an employer, so I'll make fun of myself. If any of my employees are ever watching this, turn it off at this time. So, and inflation's up 9%, right? So, but at the end of the year, employers go to their employees and they say, we're gonna give you a 9% raise, and they act like heroes, but you're treading water at the same time. And leave it to an employer to always take credit for something that keeps you in the exact same place where you were before. Anyway, to answer your question, the wherever that was, it's wage inflation is always salary increases. And then how you frame those is just salaries going up. So we have to be mindful of that. And the actuaries are gonna say to themselves, okay, well, over the course of a career, call that 40 years, over the course of the career, we expect inflation to rise at, call it 4%, 5%. That's a little high. Call it 2.5% nominal rate, whatever. But then you would also expect that an employee entering the workforce at age 20, by the time they're age 60, their salary will probably have doubled or tripled. And that's not wage inflation. That's what we call service cost, or the additional salary that accrues to employees who've been around long. Maybe they're getting service credits, maybe they're getting tenure credits, maybe they're matriculating from one job to a higher paying job in terms of promotion. You gotta account for all that. And because you have to account for all that, you gotta come up with all these crazy estimates. Because you gotta come up with all these crazy estimates, there's so much room to manipulate these numbers, it's not even funny. Which, the longer I teach this class, my fear is that by the time you're done taking the class, you're like, accounting's a whole bunch of nonsense, they're just making it. I suppose if you're a cynic, or if you're trying to work the system for your own gain, you might not be too far off with that conclusion. Notwithstanding, it's meant to actually work and present the most accurate economic picture that we can present. Because if we owned this company outright, we would want to know this. When you're trying to assume the best of something, when you're trying to assume the best of the industry of accounting, of the field of accounting, just assume that we're going through these exercises as if we owned 100% of the business. So we're reporting back to ourselves. Now we're not trying to manipulate it. Now we're not trying to get ourselves paid. Now we're not playing the game of find the penny. Now it's a real and honest question. Well, how would we go about accurately reserving for what we owe people in the future? And now we're monkeying around with people's retirements. So we want to do this right if we have any moral backbone whatsoever. So we want to make honest attempts to get these numbers as close as we can, so that we can create an investment portfolio that will track that liability over time. And if you've taken investments yet, you might have encountered the term immunization. So defined benefit pension plans typically use a strategy that they call immunization, whereby they will match the duration of the liabilities that are inside of that plan 1-for-1. And if you can match that duration perfectly, then the value of the liability and the value of the asset will move in lockstep. And once that's done, as a CFO, you can check the box and rest easy at night knowing that you're going to have the funds necessary to pay your employees that pension check when they need it. Alternatively, and I have a brother-in-law who works for DaVita. He's doing this right now. He's going through an exercise to refinance some of their debt, and in the process, you can work with insurance companies that will all kind of offshore some of this risk. They're like, okay, well, we'll immunize that for you, and you can sell those liabilities and assets to an insurance company, then you never have to worry about it again, and you don't even have to do the accounting work. So that's an option when you get out to it. Practice, I guess. Okay, moving on. So that was the defined benefit, projected benefit obligation. We're going to compare that to pension plan assets to calculate our funded status in the example that I just gave with Boeing's plan assets decreasing by $10 billion last year. That would decrease the funded status by $10 billion. So that's a pretty simple calculation. Obligation less assets. And you can see how so this is a good bullet point here. This third bullet point on this slide highlights some of the difficulties associated with making these estimates. These factors make it difficult. So the payments often don't occur for many decades in the future. Number of employees eligible. What's the lifespan, longevity, payment dependent employees. So that's the example I gave of my grandmother. She was not an employee, she was a spouse. Let's take a look at some of the data. The data is known. We look at median plan assets divided by the projected benefit obligation. If we are fully funded, what would we expect that ratio to be? Anybody?
What is the question exactly?
So this ratio right here charts median plan assets for the S&P 500, so Standard & Poor's largest 500 companies in the US, give or take. We're going to take their plan assets and we're going to divide by their pension benefit obligation. So how much they have divided by how much they owe. So if you're fully funded, what would that ratio be?
Like you were mentioning, should be.
That'd be 1-to-1, yeah. Well, this graph only goes up to 88% or 0.88. So over half, the median company in the S&P 500 is underfunded by a lot. And as of 2009, they were underfunded even more. I mean, we were down here 76-77%, and that's the median. So rest assured, bottom quartile is down here under 50. So if you're working for one of these companies that has promised you a pension plan, you need to know what that ratio is. Because that is going to affect the likelihood that there's going to be a check waiting for you. This is, it is better to, since 2018, markets up substantially. I want to say 25%. And as the market goes up, despite last year's negative performance, as the market goes up, this ratio has continued to get stronger and stronger and stronger. So that's a good thing for retirees. A little bit of perspective there. Okay, back to the account. This is the type of report you're going to see in the back of the 10K. You can see projected benefit obligation at the end of the year, and then we want to track the change in plan assets. So we have the fair value at the beginning of the year. Then we have the actual return on plan assets, company contributions. We're going to subtract any benefits paid because those are liabilities that we no longer owe. We have paid those liabilities, so we can deduct them from the PBO. Then sometimes you'll see pension settlements or other items that factor into that calculation, and those would be disclosed. That gets us to fair value of plan assets at the end of the year, and we can track our funded status. See that from 2018 to 2019, FedEx, well, their funded status decreased by almost $3 billion. So how would they have accounted for that? Well, they would have accounted that with, I'll show you here. It's coming. Before we get there, we'll just note this is an example of the type of liquidity slide that you see with leases, and we've touched on it a couple of times in this class, certainly bonds, other obligations that are coming due over the next 5 years. Very typical for a company to have to disclose those. So factor that into your liquidity analysis. Another thing that we saw last week with the banking crisis, touched on this in module 2, was evergreen debt. Evergreen debt is that concept whereby a company finances itself with debt, and their plan for paying off that debt is at the end of the term, they're gonna go borrow from another bank and pay back their old bank with the money that they just borrowed. It's very common. It's just like refinancing a house, happens all the time. It's called an evergreen debt strategy, and it works until it doesn't work. And back in a bank crisis, it does not work because banks lose access to their capital very, very quickly. The mid and small sized banks last week were appealing to the Federal Reserve to backstop the FDIC insured portion of deposits and raise that to $1 million or more, and or guarantee to the public that they would back all deposits for the next 2 years. Now, why are they doing that? Well, because we had one bank run, Silicon Valley Bank. And maybe that was idiosyncratic. Silicon Valley Bank was doing business with big tech firms, venture capital, they're out in Silicon Valley. And they had a substantial portion of their deposits that were not FDIC insured, because these were big corporations. So when they got wind that there might be anything going on at the bank, they transferred their money very, very quickly. Now, is that going to affect mid and small size banks? Well, maybe, maybe not. Most mid and small size banks have their deposits that are a much higher percentage are FDIC insured, typically 70 to 90%. So you might think that the risk is less, but the liability side of the equation, where Silicon Valley Bank actually had their money, is the same, because they weren't extending risky loans. They were actually buying long dated treasuries. Well, in a rising interest rate cycle, rising interest rate environment, those long dated treasuries lose money. Now, Silicon Valley Bank, they get a run, they have to fund those depositors. Depositors take their money elsewhere. In order to stay liquid, they have to sell those long dated securities. Those were supposed to be held to maturity. Well, when you sell held to maturity investments, you've already communicated to the world in your filings that these securities are not going to be sold. So now you're doing something you told everybody you weren't going to do. That's a big time red flag. So investors get spooked. Well, a lot of mid and small size banks are in danger of them. And I need to do some more research on this because I don't know the magnitude, but I heard just this morning on Bloomberg that 67% of all commercial loans that have been extended are held by mid and small size banks. So we office in Corbett Woods. Corbett Woods occupancy rate is about 50% right now. Our lease is coming due, so we're kind of poking around, figuring out where we want to lease again, and we're talking to our agent. About 50%. Well, that's pretty standard nationwide. That's about the occupancy rate. So the next crisis never looks like the last crisis. So it won't be a residential mortgage crisis this time. It's just not going to be. We fixed that. That's where the market's focus went in 2008, 2009. There's no ninja loans. There's no aggressive home lending, not anything like it was. So the next crisis won't look like the last crisis. I wonder if there's another shoe to drop, so to speak, in that commercial real estate market somewhere. Haven't seen it yet, but we got a lot of mid and small size banks appealing to the Fed for a backstop. That might be where it's coming. Another exacerbating problem in the midst of all this is that the larger banks, post Lehman Brothers, were deemed too big to fail. Now, what's that mean? Well, too big to fail means that they're given preferential treatment by our government, their status that comes with that, there's an implicit guarantee of all their deposits, because the Federal Reserve is not going to let them fail. But in exchange for that, they have to adhere to, I think it's tighter capital requirements and more audit oversight. So it's kind of a pain in the butt if you're too big to fail bank. But at this point, depositors are asking themselves, why wouldn't I transfer my account from UMB to Bank of America? I don't know that there's anything wrong with UMB. I've been banking with them for 20 years. They're great. But Bank of America is too big to fail. So I get this implicit guarantee over here. What's the answer to that question? Not it. I haven't been able to come up with a great one. And I think depositors all over the country are asking themselves the same question. And unless we can come up with a reason for them not to, then the mid and small size banks are going to continue to be at risk and under pressure of potential future bankruptcy. So we have got to put a stop to this negative news cycle, or we are at risk of contagion. I would be very, very interested to hear what Chairman Powell says tomorrow and what his thoughts on the matter are. So a little diversion there, but it's kind of all very relevant to the economy. Okay. Let's just slide. So this slide shows us the sufficiency of plan assets. We're looking at benefit payments in red and return on plan assets. And so return on plan assets are going to show us what our gains and or losses are in any given year. And as long as the blue is above the red, we're having a good year. We can keep those two lines moving together, then we will have come very close to that immunization number or factor that I mentioned above. Okay, I circled the last bullet point on this slide. Says in this case, the company might need to use operating cash flow or worse, borrow to cover its pension benefit obligations. Our authors are giving us a little bit of insight into how management teams have to deal with a pension asset to pension benefit obligation ratio that's starting to dip below 1, below 0.8, below 0.7, below 0.6. Eventually you have to fund that. Now, what's the temptation? If your ratio that we just looked at a minute ago is 1 to 1, great. You're not worried about it. 0.9, if it's 0.8, if it's 0.7, if it starts moving in the wrong direction, what's the temptation?
Borrow to pay it off or to use your operating capital.
Yeah, I'm thinking a little differently. If you're in Vegas and you lose a hand, you lose a second hand, you lose a third hand, what's the temptation?
Keep playing.
I gotta press. If you lose the first hand, well, let's double up and see if we can win our money back. It's the same temptation for these CFOs. Like, well, let's take a little bit more risk with the pension portfolio. And that's a nightmare scenario. Because as soon as you start taking on more risk to cover up prior mistakes, rather than taking the loan is the prudent decision. But that goes on your balance sheet. The whole world can see it. If you just take your portfolio of client assets, let's go back to the Boeing example. They lost 10 billion last year. Oh, okay. Now we thought we needed a 6% rate of return to pay our liabilities. But if we could get a 9% rate of return, we wouldn't have to borrow any more money. We wouldn't have to fund the plan. And if we don't have to fund the plan, it's not a drag on earnings. And if it's not a drag on earnings, we can all get paid because our bonus is going to turn. So the temptation is to take more risk with that investment. Well, what goes up, what can just as easily come down, and that can end very, very bad. Okay. So then our authors take us through the trade-offs and the mechanics of calculating the PBO. So we have on a periodic basis a service cost. So service cost is the cost associated with the calendar year turning over, because we know all of our work workforce just got another year older. We know some of that workforce is getting wage increases. We know some of that workforce is navigating into new jobs. All of those assumptions are implicit in this service cost expense. Interest cost, that's just present value accounting, return on plan assets, and actuarial adjustments. Now, periodically, we will have an actuarial adjustment. If you look at, I was listening to a TED Talk this week, and this, I forget what his credentials were, but he was interesting. And the journalist was interviewing him and said, you know, if you look back at the last century, last 100 years, 20th century, and you identify, you know, the three most salient, most prominent events, you know, what are they? What do you think? And the first one that immediately came to my mind was World War II. Okay, you know, the advent of the nuclear bomb, we harness the power of that. That's got to be up there, right? Maybe you think of landing on the moon. Maybe you think of the internet. Like, nope. The most prominent event in the 20th century was a doubling of the human lifespan. Okay, that's pretty big news. You know, that average lifespan in the beginning of 1900 was about 40. Average lifespan ending the year 2000, about 80. So we did that inside of a 100-year period of time, and that's pretty gosh darn remarkable. Well, what that means for pension liabilities for a company like Boeing, they started this pension plan before 1950, so they've been around for half that century. So in that time, they've had to change their pension plan assumptions in a big way because they've been there. So when longevity goes from 40 to 80, your pension obligations just double. So they had a $70 billion liability on their books. Now that goes to $140 billion liability on their books. That doesn't happen in one fell swoop, but over time, they have to make those actuarial adjustments. So when you tweak it just a little bit, your liability is going to move dramatically sometimes up or down. And FASB tells us that we can adjust for that through the other income avenue. Service costs, interest costs, investment returns, a little bit more detail on all those, actuarial adjustments. You know, we also have the ability just to, with most of these pension plans, year of benefit payments. As the company, we maintain some discretion with regard to, you know, how we want to pay those out. Okay, I gotta get to taxes. Okay, pension expense smoothing. Okay. These are the two categories of pension expense that FASB tells us we can smooth. When they use the term smooth, that means that we get to take any excess and put it into other income, so we don't have to run through net income. Large investment gains and losses on pension assets and changes in the PBO that arise from actuarial assumptions. So here's our net pension expense. This is how we calculate net pension expense. This actually goes on the income statement. We have service costs plus interest costs. We're going to subtract the expected return on plan assets. What is the expected return on plan assets? The assignment that I'm going to give you for this week is, if your company has a defined benefit pension plan, find out what the expected return on plan assets is. It will be disclosed in the back of the 10K. So what, before you even go looking for it, what do you expect? So this is the same number that we're going to use to discount all the future cash flows back to the liability that we're going to report on our balance sheet. Okay, that's a big input. So the higher that number is, the lower the present value of the liability is. So if we want to look like we're fully funded, we have control over this number. We're going to make that number as high as we can possibly make it. Now, what should it be? If you're operating with goodwill and you want to fully meet the future obligations of those retirees, so you don't have to, no, so I don't have to tell my grandma she's ever has to live on cat food. What do you make this number? Somebody throw a number out there.
20%.
20%. Okay, if you make that number 20%, then that is implying that your plan assets, your investment portfolio, will generate 20% over the lifetime of those obligations that you have. If you can do that, your pension benefit obligation is going to be very small and manageable today. But you just signed on for a rather Herculean investment return. Now, I know a few hedge fund managers that have done that throughout the course of the last 100 years. If a careful study of the field of investments will yield a few that have generated a 20%. But if you look back at the history of the markets, just kind of take your median investor, call that an index fund. Your typical 60-40 portfolio would have yielded about 6-7%. That's a normal, that's with inflation. So I would suggest that if any of your companies are using something higher than 7, you might raise a little pink flag, because they're going to have to employ some extraordinary measures. They're going to, if they're using something higher than 7, they're implicitly saying to the market, we're better than most portfolio managers. Most portfolio managers haven't done what we think we can do with our plan assets. So you say, okay, great, who are you using to manage this? But he or she must be very, very good. So that is a way to kind of identify some red flags. Okay, pension plan assets, this is how we calculate those. We're going to add the actual returns, any contributions to the pension plan, subtract benefits paid to retirees. We went through all of those. Star this chart, page 46. This is a great opportunity for multiple choice questions. What happens to your pension expense when we raise the discount rate, i.e. expected return, when we raise the investment return, wage inflation, and how do each of those inputs affect your PBO? Okay. And that's gonna have to do it. So go through those slides and refresh your memories a little bit, spend some time getting to know the ins and outs of pension benefit account. Now, on to income tax reward. Deferred tax assets and deferred tax liabilities. I don't know what my mental block is with deferred tax assets or deferred tax liabilities, but every time I teach this class, I have to go through these slides and think, okay, deferred tax assets, deferred tax liability, remind myself how they work. And they have always been a challenge for me. And I'm hopeful that you will benefit from some of my prior pain. Because the alternative is I muck it up again and we all leave more confused than we started, but let's give it a go. So all companies keep at least 2 sets of books. We have 4 sets of books. We keep a set of, and there's nothing unusual about this, but we it sounds really bad. It sounds really bad. But we have to keep a set of books for the IRS. The IRS has different rules. Like last year before, there were all sorts of tax incentives for responsible energy. You want to put solar panels on your home, you can get a deduction for that. You want to operate your business with to take advantage of certain tax incentives, you can get a deduction for that. Okay, well, you have to account for that. And that's a set of books. So you keep track of your cash flows in accordance with all of the rules that allows you to report to the IRS. It's a set of books. So most companies have GAAP. Okay, so generally accepted accounting practices that you report to the public markets, so that's GAAP. And then internally, we have a set of managerial books that help us manage our own firm. Managerial accounting is very common. There's no rules associated with it. We just account for it in a way that helps us keep the best grasp that we can keep on our company as owners. And then our fourth set of books is for reporting back to our minority partner. So we have two entities that own our firm, a majority partner, which I'm a member of. It's a corporation, it's a holding corporation. And then we have a minority partner that's based out of Indianapolis. And on a quarterly basis, we present books back to our minority partner. Well, the two entities in this case have an agreement, and that's a contractual agreement that codifies exactly how we're going to keep track of the numbers for distribution purposes. That allows us as the owners / managing members to deduct things like salaries and healthcare and benefits. Different rules, different set of accounting, different set of books. So we have 4 sets of books. Most companies have at least 2. We'll report to the IRS, we'll report to the public markets using GAAP. When those sets of books differ, when there's different accounting treatment, I'm going to give you an example. It will result in an entry that reconciles those 2 books. And that entry is a deferred tax asset or a deferred tax liability. So when the IRS makes us pay more than what GAAP shows, we have a deferred tax asset. When the IRS requires us to pay less than what's reported on our GAAP financials, we have a deferred tax liability. Let's go through an example. Okay, the example that I find easiest to understand is depreciation. Depreciation is typically one of the first concepts covered in every accounting class. Most students have a grasp of what depreciation means. We don't have to elect the same depreciation schedule for reporting to the IRS that we do for GAAP. And there again, that introduces all opportunities for shenanigans and find the penny and to manipulate the accounting, but it's just the way it is. The IRS allows us to choose an accelerated depreciation schedule, for example, whereas we might, for GAAP purposes, elect straight line depreciation. In this example, that's exactly what our authors have laid out for us. So during the first 2.5 years, tax depreciation is going to be higher because we're using an accelerated depreciation number to report to the IRS. So that's this pink line right here. You can see accelerated depreciation is just call it 200 in year 1, whereas straight line depreciation is 100. Let's go through the math. Actually, I changed the numbers on us here. Okay, so let's use this example. Company purchased an asset with a 2-year life for $100. For GAAP, straight line is used. We're gonna depreciate $50 per year for 2 years. For the IRS reporting, we're gonna use an accelerated method of depreciation, and we're gonna deduct 75 in year 1 and 25 in year 2. Here's how that accounting works. So income before depreciation is $200 in both instances. The income is the same, but our depreciation numbers. For financial reporting, we are reporting $50 in depreciation. To the IRS, we're reporting 75. Now, why would you want that? Why would you want that number to be higher when reporting to the IRS?
Minimizes your taxable income.
Pay less taxes today, so we can manage our cash flow, we can report higher earnings. Let's make it so that let's make it, if at all possible, that we delay payment to the IRS as long as we possibly can. That's just kind of general savvy tax management for corporations and individuals alike. So that's exactly what we're doing here. We're trying to manage our cash flow by taking advantage at every touch point of IRS rules. So now when we do that, you're going to see that our income before tax, the numbers just flow normally. 150 for financial reporting, 125 for taxes. Income tax expense, this is where it gets a little squirrely. Now these these numbers have to foot and crossfoot. We have to be able to balance our balance sheet. So when we report taxes, our income tax expense is 40%. Well, we have to take 150, our income before tax, and multiply it times our tax rate to get the $60 in tax expense. Now, that's a real expense for GAAP, but it doesn't represent cash that has flowed out of our bank account. Because the cash that actually flowed out of our bank account is over here. Only 50 left the bank. Now we have a problem. Because we recorded an expense of 60, but we only credited our cash account for 50. So there's a missing entry there. So if you think about the way the accounting works, now you're in your Excel spreadsheet or QuickBooks and you're back to your debits and credits. Well, I always start with cash because cash is the easiest way to approach any debit and credit puzzle. We just pay $50 in cash, so we know we have a $50 credit to cash. While over here, we have a $60 debit to income tax expense. So we need a $10 credit. That $10 credit is going to come in the form of a deferred tax liability. And it's a liability because at some point in the future, we're going to have to pay this $10 differential. We're going to have to pay $10 more than what our books say that we owe. And when we do that, that deferred tax asset is going to be wiped off our books and will be even Stevens.
Is that annually rectified? Or do you do that like every, if you get audited? Is that how these things are for? I wasn't sure if that was.
This is a very, very simplistic example. When you're in practice, you'll find sections of the tax code that have an impact on, you just call it almost every instance of your account. So you see companies trying to take advantage where they can, and the disclosures for this go on and on. Fortunately for us in this class, we just want to make sure that we have a kind of a rudimentary understanding of the way deferred tax assets and deferred tax liabilities function, how they end up on the books, what the differentials are, where to go in the 10K statement to get kind of the disclosures on that. I'll show you that here in a moment. This next slide is how that's reversed. So this is the following year. In the following year, we depreciate the same 50 for the straight line, but the accelerated depreciation method is only 20. So follow the numbers through and you can see the cash we pay to the IRS is 70, whereas we're only booking a tax expense for 60. So that deferred tax liability that we booked last year for $10, well, that comes due, we owe it. Our IRS reporting is showing that we owe 70, but our GAAP is only showing 60. So that deferred tax liability is due. We'll credit that, and that'll result in a zero balance to that deferred tax liability. Okay, so that's a high level overview of how those end up on the balance sheet. Here's some other examples that lend themselves to deferred tax assets and deferred tax liabilities. Net operating loss carry forwards will result in a deferred tax asset. Yes, asset, thank you. You see the way my brain just bogs down on me. Like, it's so slow and it always has been. I wish I got it. So just take everything I say in this lecture with a grain of salt. If you have any inkling that you need to double check what I have said, you're probably right. But this will result in a difference between your IRS books and your GAAP books, because a net operating loss gets us a deduction on future years IRS reporting. If you've ever lost money in the past, you can deduct that from your tax bill in future years, but you won't deduct it as a loss again for GAAP. You'll never see it again for GAAP, but it's valuable from an IRS perspective. Okay. Here's your disclosure page. So Hewlett Packard we're looking at here. When Hewlett Packard discloses in their footnotes the breakdown of the deferred tax assets, you can see that they have deferred tax assets associated with those loss carryforwards that we just looked at. They have deferred tax assets associated with intercompany transactions excluding inventory. I don't know what that is. It will be disclosed in the footnotes, and it's probably going to reference the specific IRS treatment of those intercompany transactions and how they're reconciled. But well, it's just out of my depth. There's so much to this field that you just have to go looking for. You have to read the fine print and understand, you know, what is it, what exactly is comprising $994 million worth of deferred tax assets that resulted on the company's books because of intercompany transactions. That's a real job to go digging into that and understanding the accounting for it. You might need help from the company. It's not uncommon at all. Fixed assets, warranty expense, employee and retiree benefits, deferred revenue, other. So it just goes on and on. We're looking for a rudimentary grasp of deferred tax assets, deferred tax liabilities. And again, we're also looking for some measure of materiality, and how these have moved over time will inform that assessment. Okay, and the last one here. Yeah, doing good. Valuation allowance, deferred tax assets. So those net operating loss carryforwards are a good example. Especially in a scenario like the great financial crisis, 2008, 2009, you had a lot of firms with huge losses, which resulted in huge net operating loss carryforwards and deferred tax assets. Well, there's something called a valuation allowance that we need to be mindful. And the valuation allowances is something that we're required to book. And typically the auditor will twist our arm here, kind of force our hand. They'll come in and they'll look at our business, and if at any point the auditor determines that, you know, you have such a large deferred tax asset on your books as a result of those net operating loss carryforwards, we don't really see a path for you to realize those. Because you have to be profitable at some point in the future to realize those net operating loss carryforwards. So if you're so deep in the hole that your auditors are like, I don't know if those are real, they're going to make you book something called a valuation allowance. So now you're going to have deferred tax asset reported on your balance sheet, less valuation allowance equals net deferred tax asset. And that's a big red flag, or can be, because that's the auditor saying, I don't think you're going to be profitable enough to realize those. And nobody wants to hear that. Everybody thinks that they're going to rebound and get back in the black, get their business going again. So that's a valuation. And if you see it, just know that somebody's taken issue with the total amount of the company's losses in the past. Okay, 66, that was as far as I wanted to make it. Today, there's a couple of examples on slides 67 through 70, but I'll let you cover those on your own time. 642, we did it. Yes. Questions before we call on that? All right. Thank you, Zoom crew. Appreciate it. I think next week. Right? Okay. Well, see you next week.
Thank you.
Thank you.